Okay, just checking that we are live again. Let's just wait and see. And okay, so I seem to be live here. Right, I found where I'm live. I'm just going to put a comment on the other video. Okay, so I seem to be live here. There we go. Now I've left a comment on the other video saying the stream is moved here. So yes, obviously this stream, I'm sorry that it is a bit clunky and moving to different videos. Chap in the other stream asked, are we going to be a Warner Brothers Discovery Moon or Bust channel now? No, I don't think I want to be following just Warner Brothers Discovery every week. This is going to be like, I think I'm just going to call the channel Moon or Bust. I like that name. And I'm just going to stream whatever I want. Whenever I'm doing financial research, I want to do once every Wednesday, record myself doing my due diligence, and hopefully either you guys will learn something, or you guys will call me an idiot and I'll learn something. It'd be great if I learned something, but also good if you guys learn something. If anything, I'm just trying to monetize me doing research. So if I can make money while I'm trying to work out how to make money, that is a pretty good situation to be in. So, right, let's just get back into this. Recap, I was just exploring whether the revenue from Barbie and like Netflix and network broadcasting are going to meaningfully impact Warner Brothers Discovery. And so the question is like, yes, we've got Barbie that's made a lot of money, but obviously people canceling their network programming, they're not going to then necessarily go back to network broadcasting. Also, we don't have cable and stuff in the UK, and I can see when people leave these networks, they're going to go over to Disney and stuff like that. They're going to be able to afford a lot of broadcasting. There is a market for people that want to watch 24-hour news, and I'm not against that being on Warner Brothers Discovery's platform, but I am really against the pop-ups during programming. Whether you will be able to turn that off, though, is a different thing. Maybe you could select whether you have those pop-ups or not. But if you couldn't select it, they've shot themselves in the foot. Okay, but what this does illustrate is the impact of network. So the loss of revenue from network broadcasting from the announcement that Disney are pulling their shows off network. So a lot of people are canceling their let me just get this up, this news. Disney pull broadcasting. So the dispute between Disney and Spectrum. Spectrum, I had to look them up, are a cable broadcasting company. Disney pulled its shows, which means people will be canceling their Spectrum broadcasting things. I thought perhaps Warner Brothers Discovery owns Spectrum. No, the concern is that when people leave Spectrum, then Discovery will make less money. Warner Brothers will make less money. But potentially people that leave Spectrum, I don't think this is necessarily bad for Warner Brothers Discovery, because if people leave Spectrum, they might also go to Warner Brothers Discovery for their broadcasting. It doesn't mean that their shows are potentially going to get less viewers, because the people that left Spectrum were the people watching Disney. And the issue I find is actually with these companies is you're paying for a lot of stuff that you will never watch. But I don't know really a way around that. You kind of do want a catalog of odd bits and pieces. Everyone is so unique. But yeah, so I mean, would you want to pay for a platform that spends so much of its revenue on a 24-hour news station? I don't know. So, and again, I just want to recap. They had to spend 1.3 billion this year. This is their debt due. A lot of this debt is due in like 2050 up to the last payment is on 2062. And you can assume that if Warner Brothers Discovery is around to that point, that debt is going to be really, really cheap relative to today's debt. Because of inflation, that is going to be super, super easy to pay. The concern is that there are two payments coming up. They're going to pay 10 billion over 2 years. And that is kind of why I'm thinking maybe I drop it now and in 2025 pick it back up again, provided that the share price hasn't surged on the basis that they are able to pay off their debt. So we've got this page. We can see network is 22 billion of its revenue, studios 12 billion. So let's go to Warner Brothers Discovery. Investor relations. And what we got is their most recent earnings release. Web forecast, 10Q form. Let's have a look at that as well. Revenues. Total revenues, 2023, 10 billion. In 2022, it was 9 billion, so 9.8 billion. So it's up 200,000, 200 million even. 2023, 21, oh, that's just in the 3 months. So, and then in the 6 months, it was 21 billion, up from 13 billion. But I believe that the 6 months, that also included, like, you'd need to do adjusted revenues because the 3 months ending June 2020 is prior to the acquisition. So everything's a little bit confused there. This is more accurate. 3 months ending 2022 June and ending 2023 June. Not much change. Costs and expenses are down dramatically by 2 billion. And then the question is, what I want to do is search debt, loss of extinguishment of debt, current portion of debt, non-current portion of debt, principal repayments of debt, including premiums to par value, borrowings. Total debt, 47 billion. We knew that. I mean, it's down 2 and a bit billion. Let's go to Yahoo Finance. If it just dropped out, I'm really sorry. I had to turn the internet off and on again. Cash flows. Quarterly. They're saying they got 3 billion in free cash flow. By the way, feel free to ask any questions, although I know there's no one currently watching this at this minute. Sorry, I'm just trying to work out. Basically, I've got these questions. How much will they make? When will they make it? And how likely are they to make it? So the big revenue segment, you've got the 3 big revenue segments. You've got licensing to places like Netflix. You've got HBO Max, and you've got advertising revenue. I'm just wondering how best to acquire that information, then how best to, I don't like to do overly complicated graphs and charts. I think it's better to keep things simple. And so and what I want to work out is, you typically want to compare this to a benchmark. So if I invested £1,000, would I make above, let's say, 20% in compound interest in 5 years? So equals sum this times 1 plus this, and then if I put some dollar signs here, it will keep it in that position, and I'll go 1, 2, 3, 4, 5. And so in 5 years' time, I would have £2,488. And so that's what I'm trying to beat. Warner Brothers Discovery, if I was to invest £1,000, and how much income would I get from that? So let's just have a look. They're saying they got free cash flow, but then we've got this chart here. And what I'm wondering is this chart, this is a beta thing that they've set up. What happens when so basically their depreciation and amortization costs are 8.3 billion, but that's kind of their way, I think, of tax loss harvesting. So basically they've not lost money, but because of the way that their company finances are structured, it looks like they do. And so they can report a loss for several years, and then they can write that loss off in taxes. So as you can see, there's no taxation when you aren't making any money, which is just essentially, it's clever financing. But then, yeah, you go to earnings, they've got negative, 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 but then they're reporting free cash flow, positive free cash flow. So I don't like these companies that juggle their finance, that have to juggle their finances this much, generally speaking. Earnings trends, Warner Brothers Discovery makes, there are flags all over this thing, but then you see at the top, the valuation. The value is hot. It's got good value, but it's the other things. And their future is interesting, but then it's just they don't have any of the other things. It's interesting that their peers is Formula One Group and Spotify technology. Current price 11, fair value would be 27. So yes, deeply undervalued compared to fair value. Valuation. This was the period at which they acquired Discovery. And this is the most recent quarter. And so you can see the profitability has gone up in the most recent quarter, or their losses have gotten less. Company industry market. So this is the uncomfortable phase before typing numbers into a spreadsheet. There's a good bit here in financial health. This is their debt to equity. And I want to show you what I want to be looking what I want to be seeing on a debt to equity graph. So this, first of all, is bad. Well, actually, no, this is okay. So usually, typically, you like to see the equity line above the debt line. And the good thing here is debt goes down and equity goes up. That's what you want to see. And then you've got a jump, which is their acquisition in that quarter. And now you can see debt going down, but also equity going down. So that's bad. Why is the equity going down? It shouldn't be. And so let's have a look. Because basically you should be paying off debt, and as you pay debt off, you acquire more equity. They had to cut a lot of employees, they had to cut a lot of fat off the business, and that's what the loss of equity is, I'm guessing. So this is Crocs. This is my favorite stock. And when you go to their debt to equity graph, this is what you want to see. So they had a massive acquisition, which was Hey Dudes. And you see this sharp drop in debt and sharp spike in equity. So like if you're purchasing your house, if you do £20,000 of mortgage payments, your debt should go down roughly £20,000 and your equity should go up roughly £20,000. Obviously, there's interest in there, which changes things slightly. But yeah, you should be gaining a lot of equity and losing debt. So there's red flags all over the Warner Brothers Discovery business. And when a company is not profitable, it's really hard to do any form of valuation. So this is why I'm contemplating so heavily exiting the position. If you want to understand why I'm in the position in the first place, it's because of that positive free cash flow. So if I could work out and trust that this figure, how it has free cash flow, and yet I can go to the net income and see negative 7.37 billion. So that's something I'm seeing more and more often that I need to understand better. Depreciation and amortization cost is 21 billion. How have they calculated that? So let's see if it's in here. Depreciation and amortization. See if that comes up in a paragraph, and then I'll have the opportunity to read about it. So it shows up on 3 different pages. Cost of revenues excluding depreciation and amortization. So what they're doing is they've got their revenue. Let's say, again, let's use the car analogy. I bought a car for £4,000 and the car is going to last me 4 years. That's my prediction, is the car will last me 4 years. Well, technically, I could put £4,000 on my balance sheet, or I could put depreciation and amortization and expense for 4 years, £1,000 each year. So even though I've already spent it, I'm taking that off my earnings every single year, which is a joke, really. But it enables companies to take a big purchase like a factory and take it off their earnings for several years, in which case they can use it as a tax avoidant technique for a much longer period of time. I think there is a cutoff, and I think that cutoff is 5 years. But I think as part of this purchase of Discovery, Warner Brothers Discovery are getting a tax avoidance scheme of essentially like 20 billion or whatever over 4 years. Again, this like what I want to, part of this theme of this channel to be, is how naive I am. I have been doing this for 10 years and I'm just getting into this deeper nitty gritty of the finance world. I think it's also a messy time to be getting into investing because there are fewer opportunities every day. There's more people discovering exciting opportunities than ever before. Total revenues. this. So excluding depreciation and amortization, the cost of their revenues are 2,800,000,000. 2 billion, and then their actual. Oh, so this is adjusted for the whole year. Their actual from 2022 is 2,767,000,000. Means their adjusted earnings before taxes and stuff like that are 2.6 billion, 2.2 billion, blah, 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 blah. Q2 network highlights. Network revenues were 5.78 million, so 5.7 billion. Revenues decreased 5% ex FX compared to the prior year quarter. On pro forma combined basis, distribution revenues decreased 1%. Advertising revenues decreased 13%. Ex FX. Primarily driven by audience declines. So advertising revenue decreased 13%. Wow, that's a fast and sharp decrease in advertising revenue. Primarily driven by audience declines in domestic and general entertainment news and news networks. Final Four championship this year, which we broadcast in the prior year, negatively impacted the year-over-year growth rate, partially offset by the broadcast of the NHL Stanley Cup Finals in the current year. Content revenue increased 18% ex FX, primarily driven by the timing of inter-segment content licensing to DTC. Other revenue increased 24 ex FX. Primarily due to services provided to the unconsolidated TNT Sports JV, previously BT Sport. Network operating expenses were 3,590. Technically, all we should care about is free cash flow, by the way. Free cash flow and cash supply. And I'm just trying to do some sort of due diligence, trying to learn something to see if the free cash flow can't be trusted. One of the things to note, I've read this financial report already one time, and there is a revolving credit facility, which I believe is 6 billion. So okay, let's look at this. Repaid 1.6 billion of debt during Q2, ended the quarter with 3.1 billion of cash on hand, 47.8 billion of gross debt, and 4.6 times leverage. Launched a debt tender offer today of up to 2.7 billion. This is something that I tried to do research on. So a bond tender offer, BTO, is called a debt tender offer, is a corporate finance term denoting the process of a firm retiring its debt by making an offer to its bondholders to repurchase a specific number of bonds at a specific price at a specific time. So how does it work? A debt tender offer is a public solicitation to a company's bondholders requesting that they sell back their bonds or debt securities at a specific price and during a certain time frame. So if I have this right, they are offering to buy back this debt. They're offering to buy back 2.7 billion in debt. For a certain price. For the bondholders, it will mean that they get more cash in a shorter time frame. For Warner Brothers Discovery, it means that they'll be paying less debt off over time. And this could be one of the things that is causing them to look less profitable than they are, because they are voluntarily buying back debt. Successfully launched our new D2C product, Max, in the US. Nominated an industry-leading 181 more Q2 revenues were 10. Revenues decreased 4% ex FX. Performer combined results presented combined results of the company 𝗦𝗏𝗧𝗏𝗧𝗧 compared to the prior year quarter on a combined basis. By the way, all of these companies I expect to see reduced revenues during a time where they're raising interest rates. It's only a few companies like NVIDIA that are seeing a momentary boom in the AI tech revolution, which so far I'm not investing in AI until I see tangible products that actually meaningfully improve everyday people's lives. Or at least, at the very least, improve the back-end side of things. But at the minute, I'm not seeing a lot of practical applications for AI, so I'm just avoiding that space for now. Okay, so we have free cash flow, operating cash flow, capital expenditure. Okay, so we have free cash flow. Let's take the 3 billion in free cash flow. Let's just look at this. I want to re-find out the exact quarter in which they purchased in which Discovery purchased 𝗦𝗏𝗧𝗏𝗧𝗏. That is the annual. So here's the quarterly long-term debt, and you can see it. So we've now got 1, 2, 3, 4 quarters in which Warner Brothers Discovery have held this debt. And in those 4 quarters, I mean, they have gone down dramatically in how much debt they've got, long-term debt. So that is a debt deduction of 51 minus 45. So they've gone down 6 billion in debt. You can see their debt payments on their cash flow site quarterly. They have paid net change in cash, debt repayment. They paid 3 billion in the last quarter, 2.5 billion in the previous quarter. But I believe on their sheet on here it says repaid 1.6 billion of debt in Q2, ended the quarter with $3.1 billion cash on hand. So the cash on hand lines up, but that figure repaid 1.6 billion of debt. I go here, Q2, debt repayment is 3.3 billion. So 1.2, perhaps it's the debt tender offer. So 2.7, so 1.6 plus 2.7, what does that equal? 1.6 plus 2.7, that would equal 3.3. 1.6 billion, repaid debt, $47.8 billion of gross debt. Let's check if that lines up with what we are getting on Yahoo Finance. You want to go to quarterly, always when you're looking at debt, always look quarterly. Long-term debt, 45.434 billion. This is definitely, sorry, this is usually trailing 12 months. So I should be looking at this section. So that is long-term debt, 44.2 billion. So maybe these are non-GAAP finances, which is a non-GAAP financial method. So this is non-GAAP. So this is them tweaking their numbers. I should have checked for that at the beginning. A non-GAAP financial measure. To see the second section starting on page 12. Okay, so they're using non-GAAP here, which, to be fair, that's not anything concerning. It's just I want GAAP prices. So let's look at their debt. And we want long-term debt. We expect that our cash balance generated from operations and availability under the credit agreements will be sufficient to fund our cash needs for both the short term and the long term. Our borrowing costs and access to capital markets can be affected by short term and long term debt ratings assigned by independent rating agencies, which are based in part on our performance as measured by credit metrics such as interest coverage and leverage ratios. Cash and cash equivalents, they got 3 billion, 3,000,000,027. They'll have a good amount of cash for the moment due to the fact that no one's going into work. My little brother works for Warner Brothers Discovery, and yeah, he's not doing any work at the minute. Doesn't work high up. He's just a runner. But yeah, so they are not doing any productions at the minute, which is going to be it's another reason actually that I'm concerned for the stock. I think in a while they will have a hard time making any money because they won't be having any new programming. It's hard to see what the overall impact of that will be. Revolving credit facility and commercial paper program, term loans, senior notes. Total revenues, 10 billion. Cost of revenues, selling general administrative, depreciation, amortization. So this is the fake one. Restructuring. God, restructuring cost a lot last year. Look at that. They've saved 900 million after the restructure. Impairments and loss on dispositions. So 11 billion total. So their costs have gone down a lot. What's costing them the most? Cost of revenues excluding depreciation and amortization. So 10,358,000,000 minus 6,636, 3.7 billion. So these are the figures that I'm going to need to start adding up. Revenue in the last 3 months, costs, revenue 10,358, 𝗧𝗿𝗡 2562 restructuring 152. 146 and 6. 146 and 6. And so that is the equals sum. Let's just move that down. Total. Done. And then, are there any other costs on this sheet? Total operating expense. And so everything else is a formula based on that. So you've got their revenues here, total revenues 10,358,000, which is up despite them cutting costs. And then you've got the total cost of operating the business. And if you exclude depreciation and amortization, which I think you should, that is their cost of running the business. And so their free cash flow, in my opinion, is sum this minus this, which is 1 billion. So where are they getting that added revenue from? Total revenues 10 billion minus operating loss. Interesting. Content is like Netflix, distribution. Income tax benefit, they get 260 million from taxes. Weighted average shares outstanding. And they haven't diluted any shares, or they have. So they've diluted 200,000 shares. So this is all in the millions, I think. In millions. And so you've got shares here. So their free cash flow per share, FCF, divided by shares, equals sum that divided by this is 41p per share. Now we've got their share price, which is at current 11.64 USD, I believe. Yep, USD 11.64. And so the yield, free cash flow per share is actually, oh, and then so what we want to do, this is per quarter. So let's just free cash flow per share times 4, because that's a quarterly one, equals sum, I know this is a bit basic, times 4. And then the yield is equals sum which one is it? So that one divided by that. So let's put that in percentages. No, it is not. It is not 15% yield. So that is in like dollars. That is $1.65 per share. Oh yeah, that's right. And so now how do we apply growth to that? To be fair, that's not even true. Cost of revenues, excluding depreciation and amortization, selling and general administrative, restructuring, impairments. That's total costs and expenses, and then it goes into operating loss, interest expense, loss on exchange rate, loss of investees net, other income expense, loss before taxes, net loss, net income attributed to non-controlling interest, income attributable, net loss per share allocated to one of Discovery Series A. Does cost of revenues include debt payments? Always using Investopedia, and I always go back and ask stupid questions. I assume cost of revenues does not include interest payments, just FYI. The cost of revenue refers to the total cost of manufacturing and delivering a product or service to consumers. Cost of revenues information is found in a company's income sheet, is designed to represent a direct cost associated with the goods and services the company provides to the service industry. Often favors using the cost of revenue metric because it is more comprehensive account of the various costs associated with selling a good or service. Cost of revenues is the total manufacturing. Debt. So no, I don't think it includes any debt costs. Just trying to work out how their net here we go. Free cash flow is important. Oh, sod off. I hate going on the Motley Fool. I don't know why Investopedia didn't come up first. There we go, Investopedia. If a company has a net loss for the period and has a depreciation expense amount added back into the cash flow statement, the company could record positive cash flow while simultaneously recording a loss for the period. So is the depreciation and amortization? Depreciation is an accounting method that allocates the cost of a fixed asset over the useful life. Depreciation accounts for the declines in the value of the asset and spreads the expense over the years of the useful life of the asset. Depreciation helps companies avoid taking huge deduction in the year asset is purchased, allowing companies to earn revenue from the asset. Net income is calculated by deducting a company's expenses, and depreciation is one of those expenses. However, since depreciation is a accounting measure, it is not an outlay of cash. As a result, depreciation expense is added back into cash flow statement when calculating the cash flow of a company. So yeah, we do want to be using free cash flow. What are negative versus positive cash flows? What does negative net income mean? A negative net income means a company has a loss and not a profit over the given accounting period. While a company may have a loss, may have positive sales, expenses and other costs will have an exceeded amount the money is taken as revenue. The thing is, what I think is happening here is Warner Bros. Discovery have only incurred a loss in an accounting sense. Just see what Google says about this. Warner Brothers Discovery reported a net loss of 1.24 billion or 51 cents per share, a sharp improvement from a net loss of 3.4 billion or $1.50 per year. Motley Fool, sort of Warner Brothers Discovery. I don't want to know if it's a good investment. I just want to understand its free cash flow. How much money has Warner Brothers Discovery lost? I'm going to have to wrap this up in 20 minutes, guys. Warner Brothers Discovery. This thing, their margin is going up. Trailing 12-month gross profit, trailing 12-month revenue. Yeah, look at that. They seem to have bought back a couple of shares and sold them again. It's very odd. Prices, financials, cash flow statement. The thing is, if the free cash flow can be trusted, then this is definitely a hold, right? So we got trailing 12-month 3.3 billion in free cash flow, which is the amount of money they have after paying their debt. It's all the annual expenses and the annualized income. Net income, look at that. Depreciation and amortization in one quarter is 21 billion. So this is what I'm like, that's absurd for one quarter. Like, is that a glitch? Because it's showing up in the trailing 12 months as well. Doesn't make any sense. Why is that there and there? That should be so let's go back to this sheet. So they got 2 billion in depreciation and amortization. So that means I put the free cash flow at 1 billion for this quarter. So this is the cash flows, this is what I'm interested in. Warner Brothers Discovery, consolidated statement of cash flows, investing activities, financing activities, cash used in financing activities, 1.6 billion. And so their net cash and cash equivalents and restricted cash, end of period, 3 billion. That's down 700 million. Oh, you never like to see the cash going down. I got to sit on this more. Cash and cash equivalents. Thing is, if the cash pile is going down and all they've paid in interest this year is 1.6 billion cash used in financing activities. So principal repayments of term loans, 2.6 billion. Principal repayments, like they paid 3.5 billion last year, 2.6 billion this year. Borrowing from debt, net of discount issuance costs. So they borrowed money. Distributions to non-controlling interests and redeemable controlling interests. Borrowing under commercial paper program and revolving credit facility. Repayments under commercial paper program and revolving credit facility. I think I've got to exit this position because I'm seeing that potentially they've borrowed more cash. And they're certainly down at the end of the period. And I see a lot of troubles coming their way, and I don't see them making good decisions on how to expand their business. And then we know that they've got two big debt years ahead of them, 7 billion in debt in 2025. So I can't really apply financial metrics into this business unless I understand if they are actually profitable. One discovery. I wish depreciation and amortization didn't exist. It's so stupid. I wish I understood why I'm getting a free cash flow of 1 billion and why Yahoo Finance is getting a free cash flow of 3.3 billion. But this all seems weird to me. This especially, because that's not trailing 12 months. That's just that figure there, which you would expect on debt, but you wouldn't expect that on trailing 12 months. Trailing 12 months should be actually on depreciation and amortization should actually be adding up the last four. That just goes to show I've got more to learn. Let's say if I go to Apple, does it do the same thing? Financials, cash flow. It doesn't do the same thing. What it does do show a very different number. That looks like it's not creating an average. What the hell is that doing? That number's completely different from the three of them. It's not an average because it's higher than all of them. I hate you, Yahoo Finance. I hate you. Loss. Right, so we got the £1,000 investment. I'm going to use my calculation of the yield, which is this here, 14%, due to the fact that free cash flow is currently 14% of. And then if I drag this down for 5 years, so 1, 2, 3, 4, 5. Right, I haven't added the 1 plus. Well, that's just adding the compounding yield, not saying that it's going to grow anymore. The reason I put 20% in the other one is because I think you could reasonably expect the S&P 500 to do 20% annually or more than that if you dollar cost average into it. I mean, if I change this to 10%, change to 10%, no. Percent, then it would outperform it, but not by a massive amount. Fact is, we can, yeah, I think I'm going to sell, and then in 2025, I'm going to then consider re-entering the position. So I'm going to put like an alert on it, and then in 2025, we'll see how it's doing in a couple of quarters. I might wait until one more financial quarter just to get more information on this stock. And I might do a bit more research on its depreciation and amortization to understand that I should be adding them back into the business. I'm sorry this video hasn't been more conclusive. I found the depreciation and amortization aspect of this business really confusing. It seems that Warner Brothers Discovery are profitable, but they are manipulating their finances in a way that they appear not profitable, which could be clever, but it also makes me uncomfortable. Okay, guys, I'm going to leave it there. That's all from me. I'm sorry if this video was a bit jolty and all over the place. I am a bit uncomfortable doing financial research while on camera. It just makes me a little bit self-conscious. But if you found this video informative, please let me know in the comment section. So, and also hit that like and subscribe button. And maybe we should do this again weekly. I should probably put this on a table that doesn't wobble and create irritating noises.